It is Wednesday, October 26th, 7 p.m. Calling to order the Joint Retirement Investment Board regular meeting. The time is 7:02 p.m. Welcome. We have the agenda in front of us. I wanted to preempt it, if you don't mind, guys. We have some very special guests with us that we'd like to have an opportunity to meet here on the board. I'm going to turn it over to Jared to do the right and fine and proper introduction.
All right, thank you. So there are three fairly new and one very new member of the Human Resources Department, Kathleen Simpson, who's the new Director of Human Resources, Peter Ritchie, who is on the WebEx as the Assistant Director.
Thank you. And
Megan Brandt, who is the new Benefits Manager. Peter's been here all of about 2 weeks and, has already made his mark, and Kathleen has certainly done so, and Megan is also doing a great job coming in cold and into a situation where there's a lot of new people in the department, all new people in the department, and they're all doing great. And I think I'll pass the baton to Kathleen now so she can introduce herself. And Kathleen, take it away.
Oh, well, thank you. Thank you for having me this evening, and it's a pleasure to meet everyone and to be here, and it's very great to be in Fairfield. And I wanted to say that we're going to do our best to pick up where Cheryl, left off, and it's tough, like I said, it's tough shoes to fill, and we're very grateful that she was able to hang in longer to help us and transition. And I know there's transitions with Millman too, and so so we're going to do everything we can to make it as seamless as possible for everyone. So I do appreciate the time, and I have, like we said, Megan Brandt is our benefits manager. She comes from Greenwich. She's super experienced. We're very lucky. And Peter Ritchie comes from Norwalk with the Board of Ed. Lots of experience as well. So we're really grateful. So if they can hear us or we can see them, I'll give them an opportunity. Megan, I don't know if you can hear us.
Can you hear us, Megan?
Yes. Hi, I'm Megan Brandt.
Oh.
I started in Fairfield as the benefits manager in August. I came from the town of Greenwich, where I was the benefits administrator working on the medical and defined contribution plans. I had experience with the pension plan, filling in for the pension plan administrator. One administrator left, and then we had a long absence before we hired a new administrator, so I filled in there. So I have experience with the municipal pension from my experience at Greenwich. I'm happy to be in Fairfield and looking forward to working with you all. Cheryl has been a tremendous help to me, getting me situated with all the plans that Fairfield offers. And it's a lot to sort through, but she's been a great help getting me situated with all the information I need to be successful.
And I'll say Megan came right into the meetings that we were having, the biweekly meetings that we're having with Millman, and dove right in and is very, brings her experience and applies it well in those meetings, and is very active and will be, probably the main person, the main conduit between Millman and the town. So, welcome.
Welcome.
Thank you. Happy to be here.
And then the assistant director, which is a new position for HR, which is much needed. So, and Peter dived in too. And without further ado, Peter, would you please say hello and meet the board?
Absolutely. Good evening, all, and thank you for the opportunity to meet with you all. It's been exactly 2 weeks, so we are still counting in weeks. As far as my transition, it's been exciting. Everything I heard during the interviews has borne itself out as far as the team, both in the HR frame, but also across the organization, across the town that I've met with so far. Coming to you all, as Kathleen had referenced, from the Norwalk Board of Ed, spent time there doing, you name it, a host of different things in support of labor negotiations, risk management, webmaster, COVID-19, many different programs and processes that ultimately, as I like to sort of summarize, looking to always look to renovate and innovate and try and bring improvements to areas. There's a lot of great things that we're doing here, but I also am excited about opportunities that we've started to see and identify and expect to deliver on. Prior to that, I've got lots of experience in the private sector world in different industries, to include hedge fund, large commercial bank, telecommunications, as well as outsourcing engagements and things of that nature. So very broad in my HR experience, and I hope to bring that to bear and in support of the town's initiatives and objectives. So thank you.
Well, we're thrilled to have you. Welcome.
Thank you.
Really, and thanks for coming to introduce yourself in person.
Oh, I'm glad I could. Yeah, well, thank you again. Thank you, everyone. It's really a pleasure, and we look forward to.
Can I ask one question?
Sure.
Do you mind? And that's, Megan, just while I have you, I mean,
break up your moment.
just from a sense, you're having bi-weekly meetings with Millman.
Yep.
And Megan, this is to you. I just wanted to thank you for bringing your expertise and your experience to bear in those meetings. We really, it was a big decision for us as a board, and we're really excited for it. Particularly, we're really excited for it to have been completed, and we know it's a lot of work. And so I just want to say thank you for putting in that time and effort.
Well, certainly, and like I said, if we can do anything we can do to make things seamless as possible, and we look forward to continuing, picking up where Cheryl left off, and I appreciate the time. So without that, I know you want to get back to your business.
Thanks for coming.
Thank you.
Thank you.
Take
All
care.
right.
Nice meeting you.
Good night.
Thanks. Well, thank you.
Take care.
Thank you. Good
Thanks,
night.
Peter and
It's
Megan.
really hot here.
Thank you.
Thank you. Good night.
Bye-bye.
Hey, guys. Thanks for allowing us to kind of preempt
Yeah, thank you.
the meeting.
Yeah.
Yeah, nice job. It's nice to have a fully staffed kind of group, kind of taking the reins. Almost.
Yeah. What Kathleen didn't tell you was that, we just got approval for, 2 other positions that need to get filled. So it's not 100% yet, but we're working in that direction and have a couple other positions to fill.
Great, wonderful.
So Cheryl retired?
Mm-hmm.
Yes, today's your last day.
Today's, that's it?
That's it.
That's it. Ah, yep.
Yeah.
All right, let's move on, guys. The minutes, if we could, item 2, well, 2B, to hear, consider, and approve the minutes of the regular meeting of September 28th. I was not here last month, so I'm going to, do you guys want to take a look at the minutes and make a motion when you're comfortable?
I had one change, under number 6, new business. I think Chris Brand asked me about Milliman.
Yep.
So I gave the update, but Chris.
Yeah, I did,
Chris had
you're right,
asked for-
you're correct.
Yeah.
Good call, I was gonna note that as well.
And Jared, give an update. I'll make that correction.
Anything else?
That's all I have.
Okay. Okay, waiting for a motion.
I'll make a motion to approve the minutes.
You're all scanning at your phones, I'm wondering if you're reading the minutes. Like, wow, they're slow readers tonight.
I'll move it.
Okay, a second?
I'll second.
Chris, all right, all in favor?
Aye.
Okay. Any opposed?
Russ is I'm gonna abstain. I wasn't here last month.
Okay, and abstain from us, I'm abstaining, so two abstentions, any other abstentions? Any opposed?
Yes, Carolyn, I was not here last month either.
That's Kevin Shadeen, so 3
Yep.
abstentions. Okay. All right, thank you, guys. All right, moving on. Brian Binkley, welcome. Happy to see you,
Yes.
WebEx. I'm going to,
I can share this.
yep, turn this over. I think we're going to be going to the HarborVest update first.
Oh, you wanna do her?
Yes, yeah, we'll have Matt lead us off. So I'm glad that he was able to join us. And can you see us all? And can you see the presentation? Do you have it up on your
We
side?
are-
I guess I mean.
We're pulling it up on our side. Give us just
Okay.
a moment. We've got,
Oh yeah, I see it coming up on your side as well.
we're getting HarborVest. It's that bottom one. You have it on the screen. There we go.
Can you see it?
I can see you pulling it up, or like in the process of pulling it up, unless there's a lag of time.
Here, let me do it. This is gonna be easier for me. Share. I just hit the wrong window. And now, there we go. All right.
This might be the quarterly report.
Yes. That looks, yeah, that's a 21 quarterly report, but you should have the presentation I had forwarded to Chris, and I believe she forwarded to the,
This is what I got.
This is what I got for HarborVest.
okay. I can pull it up
You
then.
guys got it?
Brian, I can also pull it up too. I have it here ready to go if that's
Okay.
whatever. I defer to whatever. I'm happy to do that.
Okay. And sorry if I attached the wrong attachment, yeah. Okay, let's do that. If you have it up, Matt.
Great. Let's famous last words. Let me. Does everyone see Town of Fairfield right here? Or maybe I haven't done it yet. Okay. How about this?
There it is. There it is.
Well, good.
Great. Well, let me know when you want me to start. I'm happy to start at any time.
Okay, I think we're ready.
Ready when you are.
Yep.
Yeah, well, have you take it away.
That's great. Well, great. Everyone, really nice to be able to spend this time with you. Thanks for giving me this opportunity. I've been looking forward to doing this evening and walking through the presentation. Before I really start, though, I just want to let everyone know my main mission here is to answer people's questions and get you familiar with what's in this deck. I don't mind stopping at any point. I don't mind answering any questions. But I think if you're asking me all the questions you have, then I'll be accomplishing what I'm supposed to be doing. Just quickly on me, my name is Matt Hogan Bruin. I work at HarborVest. I've been in the private equity business actually about 27 years, so a long time. About 20 of those years, I was a fund investor. So I actually invested in the types of funds that we're going to be talking about this evening, and actually did it at HarborVest. I spent many years at Bank of America and did it there, but have been now at HarborVest a number of years. So my day-to-day job is I work with a team here at HarborVest, of which I'm a senior member who's also is really co-managing this relationship. I work with the team here that also works with the Vanguard team, and together we design what this program is going to do. And then I literally meet with Vanguard on a daily basis, letting them know what's going into the portfolio, how the portfolio is performing, answering their questions, and also making a lot of presentations within Vanguard, just so that everyone at Vanguard is up to speed on the various investments that are in we now actually have 3 active vehicles. Our 2020 vintage, our 2021 vintage, where I'm going to be spending most of my time this evening, and in the fund in which, the vehicle in which you're an investor, and then I'll be spending some time on 2022. So maybe I'll move on and just just speak up if you have any questions. But I know that, as I understand it, most of you are fairly familiar with what the program does. I wanted to spend a minute, though, just kind of refreshing everyone, just so that we're all on the same page. And so, as you know, Vanguard and HarborVest have partnered together. We've been doing it about 3 years now, where we create a private equity solution for Vanguard clients, where we're including primary fund investing, so really, buyout and venture capital funds, investing in those, secondaries, so secondary transactions, and by the way, I can describe what all of these are if anyone needs that, as well as direct co-investments, where we actually invest directly in an individual company. And as you can see, this is the intended portfolio construction of these vehicles. All the vehicles have the same portfolio construction. We're really trying to do the same thing every year. And so A large percentage of the deals are going to be in primary investments, kind of about 60%. A healthy amount are going to be in secondary investments, about 25%, and then the rest are going to be in direct co-investments, that is, investments directly into companies. A lot are going to be in North America, about 65%. A fair amount in Europe, about 25%, and then the rest in Asia. And by the way, we're doing all of these things. We're accomplishing all of these goals. And then a lot of what we do at HarborVest tends to be in buyout, and so that's going to be reflected in the portfolios that we're putting together. We also do a fair amount of growth equity and venture, kind of about 20% of the portfolios for the Vanguard HarborVest private equity program. And then the rest in special situations. And so special situations are really debt investments where maybe they might be in distressed companies or in some way generate private equity returns, which is something debt doesn't usually do. Sometimes it does, and sometimes we get those sorts of those prospects into our pipeline. And if we see a really compelling one, we might do it. So Vanguard and HarborVest decided at the beginning of this program that it would allow for some ability to do that, though we don't think we're really going to be doing much in special situations. This is largely a buyout in venture and growth investment strategy. So let's talk about 2021. And let me just say some high-level comments first. The portfolio is going very well. We feel very good about it. And I will talk a little bit about how the market has changed over the last half year. And so I'll mix some of those comments into what I'm saying, but I'll also be spending a little time at the end of the presentation talking about it. But again, let me know if you want to talk about any of this. Typically with a vehicle, and this vehicle started in July of 2021, and so it's very early on in its investment period, very early on. We're just past the 1-year mark. We actually have a 3-year investment period to deploy the capital in 2021. What we try to do is deploy the secondaries and the co-investments, the direct co-investments, within a 2-year period. And the reason we do that is because they tend to, you're usually able to invest that capital in those strategies faster, and they actually exit and create distributions historically much faster than primary investments. And so really to start getting clients capital back in high performing investments, we like to do co-investments and secondaries on a faster schedule than we do the primaries. Our investment period is still 3 years. If it turns out that the secondaries and co-investments go 3 years, that's okay. But what we're trying to do is deploy those in 2-year periods, primaries in 3-year periods. We take a while to mark up a portfolio, even if we feel good about it. We feel good about this portfolio. So you'll see the TVPI, the total value to paid in capital. So really the multiple. What does this generate in terms of a multiple? We're holding it 1x. We're really holding it at par. And that's because we're trying to be conservative. And even though we see some nice upside in the portfolio, we always try to be conservative, and we wait at least a year to start marking things up. I would say that generally that feels conservative, given how the public markets have behaved over the last several months. I feel like that conservatism is probably warranted. We do expect valuations to come down at least somewhat in the private space, and they have come down a little bit since March 31st to June 30th. And frankly, valuations have come down only about single-digit percentages across primary, secondaries, and co-investments. So we haven't seen a large decrease yet, and we're not sure that we're going to see a large decrease, to be frank. However, we do expect probably there could be some additional decrease in some of the valuations going into the next quarter as investors and sellers of companies really start to absorb kind of exactly where the economy is. Again, we don't know that that's the case, but I would also say, even though given how much volatility there's been in the public markets, we do know that it's a possibility that the private markets could go down further in the next quarter. I will spend some time though at the end of this deck showing how private markets are often much smoother than public markets and over a very long time period. And so hopefully we all take some comfort in that. But so far, this portfolio is performing very well. We've got the mix of primaries, secondaries, and co-investments. that we had anticipated when we drew up the tactical plan for this program with Vanguard a couple of years ago. Secondaries at 17% is a little behind pace. But frankly, this vehicle, as I keep saying, is early on in its investment period. And so you would expect a little volatility, as even one investment can throw off the percentages here. We have a couple of secondary deals that we've committed to, but have not closed into this vehicle yet, but will close into this vehicle. So that will officially go into the vehicle. Once that happens, we expect that secondary number to go from 17% to somewhere in the 20s, maybe even low 20s. But long way of saying, we feel good about this vehicle already, or even early in its life, is really starting to conform to the tactical plan that we've drawn up for this program. So we feel good about that. Please ask questions. I've said a lot there. I'll be quiet for a second.
The 18% exposure to technology-focused funds, do you think that changes at all? Is that still the plan for this fund in light of the pretty dramatic kind of re-rating of technology stocks overall, and and the higher kind of cost of capital that could be affecting them?
It's a great question. So actually, that number is I just heard that the number is actually at 20% now. So it says 18 here, so it's at 20% now. I would say that typically we don't like a sector to get more than about 25% of the portfolio, but that's at the end of the life of the portfolio. This is still early on, and so that number is probably jumping around a little bit. So it could very likely grow out of that with new investments that come in that aren't technology based. I will say though, we tend to do about 20 to 25% in technology, in part because essentially technology is, almost every company is in some ways a technology company or relies heavily on software or enterprise software, etc. So frankly, we're a little bit more comfortable with technology being in this kind of 20 to 25% range, just because we think it's really, that technology space is so darn diversified, because it touches healthcare, it touches business, it touches B2B, C2C, it touches everything. So we think it's going to go a little higher than this over time, but not much higher. And B, we feel pretty good about that because of the diversifying effects of the fact that technology, it covers so many different industries and company types. I hope I've answered your question there.
Yeah, okay.
Matt, Eric Caliper here. What kind of discounts are you currently seeing in the secondary market through the distress?
Yep. So we've seen literally everything in the last, let's say, couple weeks, but actually even over the last many months, it's been similar. We've recently done a deal that had was 82% of par, so about an 18% discount. We also recently paid 101% of par, and so we paid a 1% premium there. Those there's a lot of factors in what drives how big the discount is. I will say we actually don't go discount hunting. If you look at our returns over our entire 40-year history, returns associated with our secondary segment, only 15% is due to the discount. The rest is due to upside, fundamental upside in the portfolios that we're buying and the companies we're buying. So we try not to go discount hunting. That is, I think, as we get deeper into whatever we're in right now, we are going to see more discounts. What you're going to see, we think, is, and we've already started to see it, is there's going to be more large institutions that want to sell off part of their private equity portfolio to generate liquidity. They're probably going to be a little bit more distressed. They're probably going to be a little bit more price takers. So we will take those prices. But again, and I sit in all the investment committee meetings here. I watch this very closely. It's not a huge driver. Obviously, pricing is always discussed all the time, but we won't walk away from good assets if we otherwise think they're good assets, even if it doesn't have a great discount. But this is a really great question, because I assume we're going to see more. That 82 number, we're probably going to see more of those than we are the 101 number that I also told you about.
Very good, Matt. Thank you.
Yes. Great questions. I'm going to show you a different cut of 2021, and I know that we don't have a ton of time here, so I'm probably going to go a little quicker through this slide just because it repeats some of what we showed before, but I wanted to actually give you some additional cut and a different context for the portfolio. This one, the value of this slide is really, you can see at the top, there's the primary, in the dark blue, the primary, and that shows you the subsegments that we have in primary. And so we do target US buyout, US venture growth, Europe buyout, Asia, and Asia buyout, Asia venture growth. And I just want to let you know that, so it's not just primaries. You know, we are thinking we're probably going to do about 30 different primary investments, but we're going to do, it's going to be cut up into smaller pieces inside this silo here. A lot of it's going to be in the US, but that's in keeping with the pies that, you know, the kind of the portfolio construction pies I've shown you. Less of it will be in Asia, but we want to make sure that we're not just doing Asia buyout, but we're also sprinkling in some Asia venture. And we'll do a couple of deals there. We're going to do about 20 secondary deals. So we do a lot of secondary deals, and we're going to do probably between 14 and 16 deals on the direct side. So, you know, kind of the name of, you know, if you let me talk all night, you'd hear me say diversification probably the most. We're trying to diversify against everything. Sector, which we just talked about, and I can go deeper into that, but sector and all of this is very diversified. I know we talked about technology being around 20. I think the next biggest concentration we have is healthcare at 9%. And then the next one is like 4%. And so we're going to be sector diversified. We're going to be geography. We're going to be stage and strategy diversified. And as well as manager diversified. I mean, it goes on and on. We're really trying to not over diversify because we don't want to just buy the market here. We do want to have an edge. And we think we can do that at these numbers. This portfolio construction is based on methodology that we've worked on our quantitative investment sciences group here at HarborVest to really determine what is the sweet spot given various fund sizes and various fund strategies for how we allocate to various strategies. So I'm going to march along to the next slide, which actually, so this is what's in the portfolio right now. And so this first slide, I'm going to show you a couple of slides here, what's in the portfolio for 2021. And these are the primary funds. Kind of the punchline here is these primary funds kind of spread across US, Europe, as you would expect, a little Asia, same with the buyout venture. Kind of, you heard me kind of beat on that drum a couple of times tonight. But these are all names of managers that we have, almost all of them we've had a long history with, some of them dating back to the 80s. And so these are managers we have very high conviction in, and the same with 2022, it's the same with 2020, it's the same with every vehicle that we put together for clients. We only invest in very high conviction names, many of which we've worked with for a long time. If that manager stops performing, we don't invest in them anymore. So there's no homer advantage here. We tend to invest in managers, though, who continue to do well, and we like to get our Vanguard clients access to those vehicles. Every time we make an investment decision here, the investment decision is made apart from the allocation decision. So the investment team covering primaries, for instance, would decide what a great deal is. They might have a deal that comes in front of them. If they decide it's great, they're going to go yes and invest in it. A separate decision by a totally different team then decides how much do our various vehicles get of that investment. So it's kind of there's a firewall between those two decisions. First of all, we want to make sure we're making fantastic investments. After that, then we're going to allocate it in a fair and equitable manner across our various pools using the tactical plans that were written for each of those pools. And please let me know if I'm going on too long about any of this. You may know all of this. These names are all marquee names, very proud to be in here. We've worked with a lot of these managers long enough, and we have a good enough reputation with them that actually we've gotten full allocation to every one of these managers. That's very rare to do. So when we ask for X amount of capital, we've gotten 100% of it across these managers. There is a fund in Vanguard 2020, the first one, where we only got 85% of our ask and everything else was 100. But we tend to get pretty close to 100%. That's same with Vanguard 2022, the next vehicle, which is much earlier in its investment period, but still has enough deals that what I'm saying still has some credence. So anyway, yes.
This is Brian. Might there be a fund here or a manager here that you've mentioned that you've invested, HarborVest has invested with so long that, say, if it was a new plan trying to build an allocation, they wouldn't be able to get access to just because of the relationship that HarborVest has?
It'd be hard to overstate that. Successful private equity and venture capital firms are famously hard to get into. You essentially, in many ways, have to have been there since day one, if not fund two, but I mean, usually fund one. And we have a long history of investing in fund ones, two, and threes, and to develop that reputation and that value add. And we have a long history of value add across primary, secondaries, and co-invest. So it all works together. You get there early, you add value, have hopefully a good reputation, hopefully you earn that good reputation, and hopefully then you're able to get allocation for your clients to these. It would be hard for someone who has not been involved with these general partners. Brian, to your point, it'd be hard to get access if you didn't have that history.
Thanks, Matt.
So this is also a snapshot of our secondary investments and also our direct co-investments. And as you can see, they're all doing very well. And I actually wanted to show you on the previous slide too. Nautic Partners is at a 0.9. That's just because it's been a little slow in deployment and it has a little bit of a J curve, but the portfolio is doing very well. So we feel very good about that. Montero is a little lower. That's J curve, as well as it has one portfolio investment that's at a 0.85 times. So not doing that poorly, but it's not at a 1 times. The rest of the portfolio is doing well. I think 0.5 is actually a very conservative number, but I wanted to make sure you saw that so far, if there's been any funding on an investment, then we put a multiple next to it that's determined by the general partner and by us. As you can see on the secondaries and the direct co-investments, there's a couple of not 0.9s and 0.8s, but again, those are actually just J curves and just kind of expenses kind of front loaded, but we feel very good about how those individual investments are doing. And on the Vanguard 2022 vehicle, nothing's marked down at all. And I would say these aren't quite marked down. These aren't impaired. But we're just trying to be very conservative. And these are 6/30 numbers. So pretty recent quarterly numbers. Our newest quarter numbers, I've heard that they're going to come out in the next couple, maybe 2 weeks, but I've heard a couple of things about that. We're getting close to getting those numbers. So I'd like to make just some comments about 2022. If there's no other questions about 2021, I am allowed to show 2021 detail in much greater detail, just because of your status as closed investors. I can't really show you too much on 2022, but I can talk to it in fairly good detail. So if that's all right, I'll just do some just kind of quick summary comments. It's also going very well. It's marked at a 1 times. It does not have an internal rate of return associated with it, just like 2021, because it's so new. And again, we kind of wait for more than a year, sometimes even 18 months before we really assign an IRR to it. Like for instance, on the first Vanguard vehicle, after a year's time, just as an exercise, we ran what the IRR was. It was 300%. Well, that means nothing. There's no way we're going to produce a 300% internal rate of return for the first vehicle. That number is going to drop. And so we try to stay away from that kind of explosive looking number when it really doesn't, that's not where the number is going to end up. So we don't have an IRR yet on 2022, but the multiple it's held at par. It just opened up, it just started investing in March of this year. I think actually the first investment was April 1st and has been off to the races. So has really been investing in earnest. Has a number of great primaries in it already. It's got 6 primaries. Again, the same sorts of names you have in 2021. Not all of the same names, but the same caliber of names. You know, Thoma Bravo, Bain Capital, Excel, Silversmith. These are strong names. Only has 2 secondaries to date, but it's several deals that are approved, not closed, that are going to come into it. But those secondaries are incredibly well diversified and have a ton of positions in them. And then 6 co-investments, a few of which are in 2021, but a lot of great holdings. One is a leading outdoor and adventures equipment manufacturer. Another is a provider of enterprise resourcing, resource planning for various corporations. one is called Action Behavior Centers, which is actually in 2021, which really works with kids who are on the autism spectrum. A really great company and just really doing great things, but also performing very well. So you get kind of that technology, but also just that services, business services. You get some manufacturing. So we're already, I feel, pretty diversified. The new portfolio, the 2022, is much more in buyout in the direct side of things, but that's fine, very early, and it's fine actually if a lot of it's buyout. But we know over time we're going to get some venture in there. I'd say on the primary side, really split between venture and buyout, kind of half and half. Again, that'll probably even out to be more buyout than venture over time. But again, no markdowns in that portfolio. Very strong pipelines across primary, secondary, and co-investment. And I think there's a variety of reasons for that. We think that the pipeline, we would have predicted it would have slowed down a little bit more. As of yet, it has not. The pipeline's been very strong, so we feel good about that. We do think if there is...
Do you have a minimum size requirement on the direct co-investment?
Yes, we do.
Are you looking for, a certain level of revenue, a level of profitability? Kind of what's the
Actually,
you're looking for?
So actually, it really is dependent on the company. We tend to want to write tickets that are at least $50 million, though, for the entire firm. And that is because if you do much less than that and you put a number of our vehicles in there, the investment sizes will be so small. And so you want to have some scale in that co-investment for us to be able to have our various pools participate. In 2022, a typical investment from the Vanguard 2022 vehicle, a typical co-investment will be about $4 million. Which is very much in keeping with the tactical plan of doing kind of 14 to 16 deals in that portfolio. So
maybe I asked the question. Maybe I asked the question wrong. So, kind of in March of this year, some of those technology companies, particularly software companies, were trading at like 20 times revenue, right, in the private markets. And so that's probably easier for you to write a $50 million ticket if you have a valuation that's based at a 20x revenue type number.
Yeah.
So in this, I'm curious about, my question kind of has two legs to it. One, as you're looking at the direct co-investment, are you trying to measure this on a valuation basis? Are you looking at kind of multiple compression? Or does a company now have to have more than, say, 10 million in ARR, 20 million in ARR, 100 million in ARR to be able to meet your criteria?
It doesn't have to have any of those things, quite honestly. I mean, we write 3 different scenarios for all of our direct co-investments. We make sure that at least the downside case makes sense. If it's buyout, if it's more of a buyout deal, we like to see that it has a good EBITDA margin. If it's more of a venture deal, we do like to see what are its recurring revenues. And so the metrics are a little different, as you would guess, between a venture and a buyout. We don't have a lot of hard and fast rules. We want to make sure that we see a fair amount of upside there. We want to make sure that we're getting a return that compensates us for the risk. We are willing to take additional risks sometimes if we think that the upside will compensate us for us. But we don't actually have a lot of hard and fast rules in terms of what the ARR has to be, what the revenue multiple has to be. Yep.
So one last follow-up on that. So is it fair to assume that because these direct co-investments, the slide you have up before us, they're all buyouts, right?
Yep.
That they all have positive EBITDA?
Yes. So I believe all of these, let me get to it. I believe all of these do have positive EBITDA. Yep. And proven customer bases, diversity in the customer base. We spend a lot of time looking at how diverse the customer base is. We spend a lot of time calling various customers. I think all of these are EBITDA positive and have a positive EBITDA margin, which isn't always the case on the venture side. But yes, these are standard buyout transactions where there might be something that needs to be fixed in the company, and that's where actually we can get some alpha edge there. And so we don't want perfectly performing buyout companies. We want to know that there's still some room to run there. But these, if I recall all of these cases, I think they're all first of all, they're almost all leaders in their industry. Like they're all kind of one or two or maybe three in their industry. And so, or if we do a roll up, we make it so that if we've identified an acquisition that's going to happen after we close, that's fine. But together, then we want to make sure that we're going to be one of the leaders in the industry, high barriers to entry, all of those standard sort of things.
Okay, and so I'm assuming the exit strategy here is you'd want to, on the buyout, ideally you'd love to access the public equity markets, right? Bring them to IPO, but can you talk for a second about the anticipated exit strategies, particularly in light of the kind of the current market conditions we're in?
I think we're probably going to see less IPOs over the next couple of years, probably. I think that's our expectation. That's all right. We can sell, hopefully, to strategic and financial players in more private transactions as opposed to going public. And so our exits, we have to have a multiple set of exit possibilities. We're going to assume that more of them are going to be private, strategic, financial transactions as opposed to IPO transactions. I will also say, I think the margin issue came up for a second there. We don't bank on any margin improvement to get to our valuations. We do know that if you grow a company, as you get to various tiers and company sizes, multiples, sales multiples tend to go up. We don't underwrite to those multiples going up. We try to just write to fundamental revenue or EBITDA growth to see what we think the outcome is going to be in terms of the exit.
Okay, thanks.
Got a question. In the European exposure, you know, with the strong U.S. dollar, how's it impacting both, I guess, Europe and the Asia investments for you?
So it is
dollar-denominated investments?
Yeah, so we actually have various different denominations. Most of them are dollar denominated. We are seeing some FX effects, and actually in some of these write-downs, some of that write-down is due to FX. And so we are starting to see that. And it's, you know, that is going to play a role in these various valuations and various outcomes. And so that's something we're watching very, very carefully. That's a great question. And that's something that we're going to be very careful about as we go into investing over the next couple of years. We're always careful about it. We always make sure that we're managing our risk there. But this is given where the dollar is right now, this is why you have to be cautious about that. We'll probably be even more cautious about it over the next, you know, number of years, or as long as this kind of dynamic continues. But this is we look at FX risk constantly with all these deals, whether we're in a flush market or a market that's got some volatility to it. Good question. I'll go on, but if you please let me know if you have any questions. I just wanted to touch a little bit in terms of, you know, we do think the portfolio has held up well, and I know that it seems with the public market going down, you would expect the private market to go down. We do think it will go down somewhat, but this is just kind of I just wanted to quickly go over the slide to really show historically that dotted line is the public equity market, and the bars are the private equity market, with the blue strikes being where the top quartile is, the yellow strike being where the bottom quartile is, and then the bar just being what the average multiple is. So first in 1997, the average multiple was 1.3 times. And so you can see that in almost every year, even bottom quartile of the private equity market outperformed the public market. So we think that that's a really good sign. You will also see that it's smoother than the private equity market is smoother than the public equity market. And that's really because private equity deals tend to be more illiquid than public deals. I mean, kind of by definition. And so actually, because of that holding period being longer, in some ways, you're dollar cost averaging constantly with private market investments, especially on the primary side, where a primary fund, a buyout fund, can take years to deploy its capital and then years to have its capital come back in exits. And so that's really kind of just, that's dollar cost averaging, 101. And we also see it in co-investments in secondaries. And so that is a smoothing effect on private equity. And we think that that's served private equity investors well over time. You will see in the later years there starts to, the public starts to outperform the private. The public's had a really good run over the last couple of years, but I would say that it takes a number of years for the final multiples to come out on these vintages. And my guess is 2017, 2018, and for sure 2018 and 2019, we don't know what those final marks are going to be. There's those vehicles that were started in those years are still in their harvest period. And that's one reason we don't even show the bars for 20, 21, and 22. It's because those vehicles, those vintages would be so early, the results would be meaningless. They would be probably less than 1 time still. And so we do think that 2018 and 2019 are probably going to continue to climb. And if history is any indicator, we think that we're going to continue to see the pattern that we've seen between public and private. But I think the bigger takeaway on this is just that privates tend to be a little smoother, and that is we don't expect the private market to fluctuate as much as we're seeing the public market. I have another slide on vintage diversification, but I know I've taken a long time here and we don't necessarily need to go over that. But happy to, Brian or anyone else, happy to take this in any direction you want.
Carolyn and all, Eric, others, other questions you have for Matt while we have him?
Are you investing in emerging managers? You talked about how you've been investing in a lot of these managers for a very long time, and at one point they were relatively new. Do you have a strategy to any sort of allocation to newer managers, or is it primarily the top tier at this point?
It tends to be a lot of the top tier. However, we are focused on emerging managers. And frankly, I worked at Bank of America for close to 20 years investing only in emerging managers, defined as managers that were either Roman numerals 1 through 3 or that had diversity in the management team of the manager. And first of all, really loved doing that. And actually, that's how I joined HarborVest. HarborVest was looking for folks who had experience investing in emerging managers. And so we do have a team that does that. That's not my day-to-day job anymore because I moved over to this role, but we do focus on it. I would say most of the deals we do, most of the primary funds we invest in are established because we're trying to invest in proven managers that we can get the best return to our clients. That said, we often do see managers that are super promising. And in fact, we have a fund called Silversmith 1, that's in the first Vanguard vehicle, 2020. It's not in 2021 just because of kind of the vagaries of timing and when what have you. And actually, Silversmith 3, was in our first Vanguard vehicle. Silversmith 4 is in 2022. But going back to, we were some of the first investors in Silversmith 1 in 2016. So between 2016 and today, that firm has raised 4 funds. We've been in all 4 of those funds. And so we did take a chance on Silversmith. But, we spend a lot of time. It takes longer to do due diligence on emerging managers because they are less proven. We tend to work with emerging managers who have worked together a long time. And so the Silversmith folks came out of Bain and Summit Partners, 2 kind of marquee grade A private equity firms, had worked together a long time, had done a ton of deals together, and on other realized deals had gotten about a 3 times multiple over a lot of deals. And so felt good about getting into Silversmith 1. Silversmith 1 then did about a 3 times multiple. Silversmith 2 is working on kind of between a 2 and 3 times multiple. And then Silversmith 3 is too early to grade, but it's in Vanguard 2020, as I said. And then Silversmith 4 is in Vanguard 2022. I know I said a lot of numbers there, but yes, we do have an allocation to it. Actually, we have a focus on this, is the way I would say it. We have a focus on it. We do have some clients of the firm who their vehicles only invest in emerging managers. And so, but in our Vanguard partnership, it doesn't have a focus on emerging managers, but it will get emerging managers, those that are between 1 and 3 from time to time. Again, we're trying to get our highest conviction names into the portfolios of our Vanguard clients. And so that's really kind of the organizing mission here. But we love to identify emerging managers. And back to, one of Brian's comments earlier is, and if you're not getting in the ground floor of these managers, it's hard to get in later. And so, just for our clients' benefit, we also want to be in high potential promising managers, both for the immediate return, but also for the shot at getting a chance to underwrite them in their next fundraise.
So other parts of the firm, other funds within your organization are going into the more emerging managers, more diverse managers. So later on, later stages, as they get bigger, they'll be brought over, potentially future vintages will be investing in them.
I'm so glad you said that. That's a really great nuance to underscore there. Yes. And so that's actually one of the benefits of having mandates that are solely focused on emerging managers is actually HarborVest as a firm gets a chance to invest and be meaningful investors and go along on that ride. Once that manager kind of graduates to bigger fund sizes and et cetera, we already have the relationship. There's a very well-known software firm called Clearlake, which has been one of the biggest home runs in managers that have started out over the last 15 years. I think they raised $30 billion in private equity last year. My team was the first investor in that vehicle, in that team in 2006. Because of that initial investment, Clearlake always comes to HarborVest and asks if it wants an allocation to its funds. So so those mandates actually focus on emerging managers, actually enable us really kind of to seed those relationships for the benefit of HarborVest, but also the benefit of Vanguard and its clients.
Great. Well, Matt, thank you. Thank you very much. That was terrific. You kind of walked us through it, kind of refreshed us on our knowledge on it, and I thank you for talking about kind of the current state and market condition and helping us understand kind of what's out there. Thank you very much.
My pleasure, my absolute pleasure. I'm always here to answer any questions too. So let me know if you have any questions. Happy to come back. But this is really great, and I do really appreciate the really great questions. It makes it a lot of fun to talk about. But more than anything, I want you all to be comfortable and see what's in your portfolio. So let me know how I can serve you in that way.
Thank you, Matt.
Thanks.
Wonderful.
Great to have you.
Thanks, everyone. I guess I'll say goodnight. Is that the case?
Yeah, I think that's fine, Matt.
Yeah, you're welcome to hang around, but can't blame it if you want to go and have some dinner. Take care.
I got to go tell my dog to stop barking. I don't know if you all heard that. So that's my next mission here.
Yeah. Misses you. Yeah.
Take care, everyone.
Bye-bye.
Bye.
Okay, Brian,
Yes.
let's do
thank
the
you.
Vanguard.
Yes, I know we went probably over what we wanted to spend, but I thought it was valuable just to answer all those questions and let him, go into all those different avenues, and I can bring us or get us back on time.
All right.
Great.
All right.
Thank-
You see it? You see it?
Yes, I do. And unless you want me to dive into it, I may skip over, the front pages of reviewing the markets and jump straight to the performance of the pension and the OPEB plan. Does that sound like a good idea?
That's fine with me. Anyone else? Okay.
I mean,
Let's do it.
we're right here is a good place to start. I mean, I will touch on the markets in general sense, but we're one quarter in to the fiscal year. I have a couple of different updates as it relates to performance, but yes, just the first 3 months of the fiscal year, no surprise with the way equity markets are down over 20% and bond markets, which is a real surprise, off to their worst start in history. So on a 3-month basis, you see the return of down 5%, slightly better than the composite benchmark. That has to do with some of, or mainly the private side, private equity and private real estate. And same with that 1-year number. I know it's not a calendar year to date number, but on a 1-year number, down 13%, but above the composite benchmark again because of the private equity and the private real estate. And so I'll spend some time on that. Before I go into the performance of some of the public and private markets, what we've been seeing because of, and I touched upon this at the last meeting, when you see down below your allocations, the current allocations versus the policy, because all the public markets have come down, the private allocations have risen quite a bit. And it's not unique to town of Fairfield, and Harbor Vest, and why they're seeing so many secondaries is people lightening up those portfolios because their private allocations have become much higher than target. So just using town of Fairfield, you see the last line, our private equity allocation, which really doesn't reflect the Harbor Vest yet because it's so new. We're 3.5% over the old policy target of 5%. I haven't updated it to 10 just because it's so new. The 8.5% is really just Lexington and Mesereau. The same could be said with the real estate. The current return or the current allocation is 7.7 versus the policy target of 5. So, as the private markets start to get more further into the year, I think those values have come down, as Matt alluded to, and I'll update you on Principal as well. But I just wanted to point that out from an asset allocation perspective. Before I go there, just looking at the low returns, your actuary Milliman, I follow some of the stuff that they publish, and they do a report for what the expected funded status is for the 100 largest public plans, U.S. public plans. And as of September, given the returns in the market, they forecast that return or that average funded status is about 69% now. So it's dipped quite meaningfully over the first 9 months, given the low returns that we've seen. So if you go to, I don't know who's paging, if you go to the next page, these are all our public investments across, and then at the bottom of the page is the private, but I'll just stay in the 3-month just to give you a sense of the asset class returns. So equity domestic down over 4%. The international markets, which have been more stressed, probably more likely to be in recession. So equity international down 10%. And then the fixed income US markets, fixed income domestic, you see down 4%, and fixed income international only down 3%. So we do have that for diversification benefits. Other central banks overseas are raising interest rates, but not to the extent the US has been. So that's why you see the fixed income overseas returns not down as much. But now just going to the private equity. So this report is as of the end of the third quarter, but it reflects second quarter values from the private equity managers. So just in general, if you looked at that bold line of private equity across the board, so negative 5.63%. If I went back to the first quarter, or our report as of June, that private equity return was negative 2.5. And if you went to the first quarter, it was plus 4.5%. So you could see how that mark has been lagged, not down as much as public markets, but it's slowly been falling from where we were 3, 6, 9 months ago, something that Matt was alluding to. But still strong, I'd say, on a 1-year basis relative to the public equity markets. That you would see that 6% absolute versus all negative number for all the public markets. And then I wanted to just highlight the next page, private real estate. 2 things. Now, private real estate has been stronger. So this 3-month return is as of June 30th for principal, but still positive 4.85%. So while that has slowly come down, it's probably still the strongest of all of the asset classes. With that said, I have a preliminary return for the third quarter from principal, and that is still positive 1%. So that's not an audited or final number from principal, but their expected return is still positive at plus 1%. The other thing that principal just recently instituted for their fund, not that it impacts the town because we're not looking to redeem anything, but the fund, the Principal Enhanced Property Fund, has implemented a redemption queue as of the September 30th. What that means is, the cost and the availability of the debt for commercial real estate has changed a lot. So it's caused a slowdown in transaction activity, something that we've seen in private equity markets as well. So investors, that want to redeem, they're not getting their full redemption at each quarter end right now. So, this is something that they put in place in previous times of stress. And so again, it doesn't impact the town since we're not looking to raise money from private real estate, but I just wanted to give you a sense of what's happening in the private real estate markets.
Do you think this is a sign that they're under any type of duress?
No, no, I don't think it's duress as opposed to not being able to or not wanting to sell properties in a down market where there may not be as much activity. So I think it's more of they don't want to get rid of the investments at a more of a fire sale price if they don't have to, and do that more orderly.
Sure, but sometimes when that happens, it causes a little bit of a run, kind of a real spike up in redemption requests, right?
Right.
We don't have a situation like that on our hands, do we?
No, because as you know, the redemption queue is not that large. So as of September 30th, there was 94 million in redemptions in the queue. So that's pretty small in terms of a 3.5 billion fund on a net basis. And so they just they wanted to protect all investors by not, doing full redemptions for those that are looking to reallocate.
Can I ask a question about the allocation mix, Brian?
Of course.
Right. So, we've got 2-year T-bills at 4%, right? I've got a pretty nice yield curve from a perspective. Do you think that we would be wise at all to reallocate at this point, or is your opinion that we stay with the current allocation?
Well, the recommendation would be to stick with the current allocation, given its long-term in nature. The fixed income markets have certainly been, very volatile, as well as how much yields have been moving around. And so just giving some insight from our fixed income portfolio managers. Yes, it's more the short term where yields have gone up. I mean, have gone up across the curve, but at this point, they feel, at least on the 10-year, we're still above 4%, but feel like that 10-year yield is really kind of capped around 4.25%. And we did hit that the other day. We've since come down a little bit. The reasoning behind that is, the curve is inverted right now in the sense of the short-term yields are higher than longer-term yields. So 2-year yields higher than 10. And we're expecting, here in 2022, another 75 basis point hike in November, another 75 in December. So the shorter end of the curve may go up as high as 5% because as you all know, the Fed is trying to get inflation under control. So they need to get interest rates kind of higher where core inflation is. And when you've looked at historical yield inversions, the typical spread has been around 75 basis points as far as, the peak inversion. And so that's why, they're saying, the longer term treasury, longer term, but 10-year is maybe capped around that 4.25%. And, they're starting to talk about we're very premature of, sometime late next year, then we might finally see hikes. So trying to time the interest rate movements from a fixed income perspective is very difficult, and therefore that's why we just stay the course with our asset allocation.
So I got a question. So like going back to that the real estate fund there, they're putting up blockers for the exits. So a lot of, potentially some of the investors could be reallocating to this denominator effect where they're overallocated, overweight, and against their policy in real estate,
Right.
They're cutting it back, so then try to get redemption. And now the real estate market is going to be also impacted next year as well as the economy slows down. So probably saying it probably doesn't make sense to keep our policy. Don't go selling stuff at a downward market more and just
Right.
stay overweight, and as things in a year and a half, when things, obviously are going to be a much different place, much lower valuations in a recession, the Fed will start cutting rates. The rates will come
Right.
down, and the values will rebound.
Right. Yeah, it'll normalize over time. And so, yes, I wouldn't suggest doing anything on the private side either. The other thing I wanted to mention, I talked about the redemption queue, but they also have their inbound queue of investors that want to invest is at 430 million. So it's not, maybe to Carolyn's point, it's not like a fire sale investment, people wanting to get out. They still have interest from their investors to invest more, but the cost of debt, because of how much rates have gone up, it just slowed transaction activity. I kind of made that point at last month's meeting. So when I look at the distributions, I'll forward this now to the end of October. So last year, year to date, January to end of October, we had 8 million in distributions from the private equity managers, Mesirow and Lexington. This year through October, the distributions are only 3.6 million. So you could see how that activity is slowed in the sense of the private equity not even paying out as many distributions, probably due to the state of the market.
So to follow up on that, Brian, so we do have some very fermented vintages, and they're struggling coming to market because of the current market rate. Should that be a concern where we are as far as cash flow right now, or are we situated okay?
Cash flow coming from the managers, or just in general?
Cash flow in general.
No, we're able to meet that, no problem, because the other 90% of the portfolio is so liquid. So if you went back to the asset allocation page, or even think about it at future state, our target is 10% to private equity, 5% to real estate, but that other 85% is fully liquid. And so when we have when we need to raise cash every month for pension payments, like we just did last week, because we have one coming up, we do that from those equity and fixed income funds. We just see what is further away from target and determining in what to sell, but absolutely no issue or problem meeting cash flow for the pension plan.
And for those in your universe that you're kind of dealing with, those that are cash flow negative, where do you see them liquidating right now?
And can you clarify, what do you mean by cash flow negative?
So I'm assuming like underfunded, struggling to make payments. I mean, maybe you don't deal with any clients like that in the pension fund, but I'm down here at the NCPERS conference,
Right.
and unfortunately there are some that are cash flow negative. And that discussion kind of came up, and PE is a long-term lock-in.
Right.
So yeah.
Yeah. So well, to your point, no, I mean, Town of Fairfield's pretty well funded. So are the other publics I work with. So while I'm just talking about the distributions have slowed from the private equity managers, like we're not necessarily relying on those distributions to fund pension payments or anything like that. So we can meet those pension payments through the liquid part of the portfolio. So we're not dependent on those cash flows to pay out. Thanks for the question, Eric. I think those are the
What do you think happens to the fixed income?
What's that?
Brian, what do you think happens to the fixed income portfolio? I mean, it's down so uncharacteristically,
Right.
down so much.
Right.
Uncharacteristic for a fixed income, right?
Yes.
I mean, do you anticipate that it can snap back, or do you think that we're going to have to work our way back from this new, kind of very low level?
No, I think likely, I don't know when, but likely in 2023, you'd expect that to snap back. So very rare to have this both equity and fixed income down together, right? That is typically not what happens. Bonds usually perform well in times of stress, but this year has all been all about inflation and then therefore the rate hikes. And so the rate hikes have been not only large, we came from 0 to 3% so far and expected to go further, but it's all happened in 9 months. So the speed of which it's happened. But as you look forward into 2023, let's just say, I'm just going to generalize, most economists, including ourselves, expect recession at some point in 2023. And in that point, then if you're getting a slowdown in growth and you move into recession, you have job losses, then the Fed starts to think about cutting interest rates. That would then be beneficial to fixed income, and you would expect to see more of the flight to safety in that time frame of going towards fixed income. So I think 2022 has been the anomaly, not that it's never happened before, but unique just because of the inflation environment. But going forward, it shouldn't change how bonds, behave as far as acting as the diversification or the ballast. When that turns is probably you have to get past all the Fed hikes. And right now, I talked about November, December, even expecting another hike in the beginning of 2023 before you get talks of cutting later in the year if there's recession.
And you don't see any reason for us to sell some of the fixed income and buy treasuries with them?
Well, the fixed income, the total bond fund that we're invested in is a mix of treasuries and corporates. So it is the general Bloomberg Barclays aggregate. So it has exposure, across the treasuries as well as corporates. But I may be missing the point, Carolyn. Is it to go short? Is that what you're saying? Like you shorter duration?
No, I'm just, look, I mean, I want to make a point that we practice some good hygiene here, and that if there's an opportunity to reallocate, we don't kind of sit too passively if we feel that the markets have changed in a way that we, that we're not looking, we don't recognize if we are confronted with a place where we have to change our footing and our allocation, right? And we've been very stayed to the course with you since we've brought Vanguard on board.
Yes.
And we've seen some real incredible market changes. And so, I just want to kind of practice some good skeptical analytical process here and say, is there anything that you feel, and Vanguard as our OCIO feels we need to change with this, or is this something we just continue to ride through?
Yeah, so we don't take the tactical approach in managing it. Just not our philosophy as far as trying to add value. It's more through the asset allocation and that those long-term forecasts that I usually share on a regular basis to meet to your discount rate. So that's those are the disciplines that we practice as far as staying diversified, which we are. We know what our long-term goal or return target is, and then staying disciplined to that allocation and not changing or in times of stress. So there are tactical managers out there, but we've found over time, whether it's our OCIO business where we compare ourselves to other OCIOs or in just active management in general, that discipline has led to better returns. So I would say, Carolyn, and it's our philosophy to stay the course as opposed to tactically moving the portfolio. The good thing is, and may have showed this in the last presentation, but the expected returns, if we look out 5, 10, 30 years, for equities have come up, and it's come up for fixed income. And that's been a big jump from December of last year. So the target that the town has, the discount rate, is comfortably within that range, that 6.9%, and that's what we're really trying to manage over.
Okay. All right.
The U.S. fixed income, is it a standard duration, or are they constantly rebalancing within those particular funds to get the shorter duration, given that the rate, the inverted yield curve to keep it more shorter term versus going longer dated?
I mean, you're talking about the existing fund in the portfolio?
Yeah.
So the
Or is it
total
purely
bond,
the management?
well, the investments that we have are all passive, it's indexed. And so, but the duration of, even of a passive fund or the aggregate index does change over the time. So last year, the duration for the Barclays Ag was about 6.9 years. It's about 6.5 years now. So the duration of an index will change over time, but since we only have the one Barclays Ag, we're just matching the duration of the ag. We're not taking any kind of duration bet. Now, if we were to implement active management in fixed income, we could leave it up to the fixed income manager or managers to tactically move around. But one thing I'll show at the next meeting, even this year, it hasn't been a good year for active management. The most recent report that came out from S&P that follows all the active management is that they haven't been adding value even in this down market. Does that address the question, Eric? Did I get to it?
Yeah.
Yeah. So the duration of the ag has come down, but it's still pretty long at over 6 years. So those are the main comments that I just kind of wanted to make. The overall performance of the private equity portfolio is that we've slowly seen those marks getting negative or coming down like the public markets, and then to update you on principal. And I gave you that statistic from Milliman of how funded status has dropped. I'm sure that we'll see that with the town's plan as well, due to the markets of the when that Milliman report comes out.
Brian, can you tell me what the duration is of the bond funds that we're in?
The total bond fund is about right now 6.5 years for the total bond market index. And I usually include the fund sheets in the presentation. This was the 1 month that I didn't, but I could forward it to after this call. Was there another question around the duration, Bruce? I think it was Bruce. I can't see it too well.
A yield on that fund offhand, as say at this point in time, as a new investment, what would that be?
Probably well over 4, but I don't know it offhand. I can log in and get it, but I don't know what the yield is right now. But it's easy
to address Carolyn's question. Can we do something active to reduce our exposure and still maintain the same yield in the event that we're wrong about where the market's head in the next 6 to 12 months? And by making, this is a suggestion, as I think Carolyn was trying to pose,
right.
And is that too actively managing what is a long-term investment?
Yes.
A lot of people are cash is where we should be, so going into a 2-year versus a 6-year definitely reduces exposure, makes us look like we're paying attention to what's going on, and that's the question. And you could do that by allocating just a percentage of the bond fund to, 2-year treasuries or whatever, something short.
Right.
That's
So if you were to go to page 7, it shows the yield curve, and for the most part, it's not that the yield curve or rates still won't go higher. We're expecting the shorter end of the curve to continue to go higher, but most of the move has likely happened. And I know this is even dated because it's the end of September and we're here in October. So a lot of the move has happened. now, or if you fast forward in the next 12 months, if you get any cuts, then that would benefit a longer duration or an ag over a short-term fund, because duration is just a measure of sensitivity to changes in interest rates. So if now you're just hypothetically to move towards a shorter duration, you'd get the yield, but as rates at some point in the future get cut, the short duration would lag a longer term duration as yields fall. And I say that because an inverted yield curve is usually an anomaly. It does, there's a typical environment, there's a term premium. You get paid more for holding longer term bonds than shorter term bonds. And so the curve in usual periods is upward sloping. It's negative right now because the Fed has to increase short-term rates to get inflation to slow down. So I guess the two big points are likely at this point, most of the move has happened. Look at the 2-year. In 12 months, it's already up close to 400 basis points. And then timing is just notoriously difficult. If and when we get a cut in 2023, again, it comes back to that point, then you're better on the long duration side. So we're just looking at what our expected returns are for these asset classes, and does that correlate to, and how does that correlate to the discount rate? So admittedly, it's not sexy and fun and being tactical, but it leads to pretty good results.
You look like you have something to add.
So yes, I mean, whether it's now or this year, we from Vanguard's stand, we wouldn't be recommending tactical trades. It doesn't mean that we wouldn't reevaluate the asset allocation like we did the other year to add private equity or increase that exposure, but we're doing that with an eye towards what's the objective of the plan, and what's that mainly comes down to the discount rate.
Well, I just look at this more holistically, right? As we're concerned about managing to that discount rate, Brian. So we're concerned a little bit about private equity perhaps softening a bit as they mark our performance is going to be down, right? And that was the biggest thing that allowed us to keep that 6.9%, right? Was the allocation, the stepped up allocation to private equity, at least in your analysis and Milliman's analysis.
Right.
We also have a higher kind of stepped up allocation to public equities. Now, I'd argue that that's where we stand the greatest chance of a snapback, a re-rating, particularly if we're going to go into a recession. The market kind of discounts that early, right? Where I'm having the most consternation, as you can tell, is just thinking about that fixed income piece of our allocation, and it's really hard for me not to think about that 2-year note, right, or even a 1-year note that I can get 4.5% or 4.25% on, right? That just might be a nice way to just soften the.
I want to play the devil's advocate for just a second. And to what Brian has espoused, and I think, we're here to act as fiduciaries for the pension plan. And if we feel that we should take a more conservative approach, that the things that you're projecting are not, it doesn't agree with what may happen in someone who has more of a doomsday scenario. I won't say doomsday, that's a bad word, but I mean, inflation could go a lot higher. Markets could be in a mess for 2 or 3 years or more, and we haven't seen this in a long time. Nick sitting here knows it, I know it, and I've seen this happen where rates went into double digits, and in those cases, the longer duration fixed income is going to get beat up pretty badly.
Correct.
So I think the issue is nobody knows what tomorrow brings, but we have to rely on you as our OCIO to say that we think steering the course is this, and this is what our economists are telling us. We think it's going to happen. So the fact that we're discussing this and leads, we don't know. But nobody has a magic
Right.
one, or is that smart to be able to know what the future brings. But by taking conservative action, you may have given up some upside if things turn, but at least you've shown that you've been diligent in the process. I mean, I don't know what other to say than that, you know. And again, this is your decision unless somehow we overrule you. I don't know how that works. You know, that's you know, look, Brian, this is just, we're talking, right?
We're talking.
Yeah, no, these are good discussions to have. I mean, the first reaction from, you know, we're all just generically, we're all hardwired to be emotional, and we see negative prints, especially from fixed income. I mean, this is the worst start the Barclays aggregate since it was started as an index in 1976. It's the worst start. And beyond that, it's probably the worst, 9 months in the history of fixed income investing. And it's because of some of the things that you were talking about, Bruce, is like, yes, we've seen inflation like this before, back in the 70s. And that's why the Fed is being so aggressive with the rate hikes, to get that under control and to not ease up until they see that come down. So it is such a big anomaly. I'm jumping around, but I got the yield for the Barclays aggregate right now. Yeah, the duration is 6.5 years. The yield to maturity right now is 4.67. So the good thing is being a fixed income investor, we're down right now, but you're investing at higher yields. And so eventually those higher yields that we'll see will be beneficial to the pension, to all investors, to get yield, to get return from fixed income again, whereas before we were at 0%. Then that brings me back, it's not in the deck, I'll put it for the next one, but when we looked at the expected return for this portfolio, this target allocation, out 30 years, since that's what Milliman uses, the current expected return at the median is now 7.06%. That's a big jump from where we were December of last year. So comfortably within that range of trying to meet the discount, the discount rate. And therefore, when we have all this noise going around, it's still important to be grounded on that long-term goal and objective.
And if I can just introduce an idea, I look around the room, and a lot of us have gray hair, some of us more than others. But we're hiring people that are 25 years old and are going to be in the pension system till they're 85. So our long-term investment horizon is way out from 30 years. And not to bring up a competition, but there's a great slide 64 in JP Morgan's Guide to the Markets, which talks about how the different portfolios recover after the March 2020 lows. And it's not that far off from a 70-30 to a 60-40 to an S&P 500. We have to think long term, much longer than what we're thinking in our DC plans, 457 plans, 401k plans. Take that and double it out. And I think that fluctuation, that noise in the market is going to fade away, to Brian's point, when you look at a long-term horizon way beyond 30 years.
Yeah.
Sage words, Eric. No, I agree with you, Eric. I mean, Eric, your thoughts or words are well taken.
So yeah, my advice would still be to stay the course with the portfolio, as far as the asset allocation, the targets, as opposed to trying to time what will happen with rates and trying to get that right. Because with timing, you always have to be right twice. You have to change at the right time to get short duration, then you have to want to switch back and to be long duration, if we're just talking about fixed income. And so duration, trying to time duration is we have found is not a compensated risk, and is, has led to poorer returns for some active fixed income managers. Even when we approach fixed income from an active management perspective, we try to keep duration within a year or so and let the security selection drive the returns as opposed to timing rates. So there's a great chart. I'll include it for the next presentation to show how notoriously difficult it is timing rates. And there's another chart that I can think of. Yeah.
I do appreciate that. I think it's pretty unusual in the long-term arc of history that we've gone from effectively zero rates to over 400, a 400 basis point increase in as short a period of time as we have been in this past 6 months.
Right.
So,
right.
We've got the two, but I hear you. Okay, and we're good. I do always want to make sure that we are talking about these issues. I feel that is our mandate, as we share that responsibility with you.
Of course, it absolutely is. We should be talking about all aspects, of whether it's portfolio construction, the funds, and revisiting those tenants. So I welcome that. It's always a good to have that discussion. So I appreciate the pointed questions. So there will be some good material for me to share.
Going back to that strong dollar, this is going to hurt corporate earnings because both U.S. companies are not U.S. companies. Most of their business is coming overseas with them slowing down much worse, and even buying our stuff is very expensive for international buyers, and that'll accelerate along with the double impact of the rate hikes very short term. We're going to go into takes time for the economy to feel the effects, but when it does, it's going to be hard, probably a hard hit the next year and a half.
Yes.
Mm-hmm.
Go to the first time home buyer, you're going out buying a 6% mortgage when 2 years ago you get practically for nothing, a 30-year. So
Brian, what is the view from the economic department of Vanguard as to where rates are going to go top in the next 6-12 months? Or do you have that?
Yeah. So in the next 12 months, we see the short-term rate going to 5%. So 75, 75, and then 50 in the new year. So that those rate hikes would bring us to 5% on the short term. So that's where we see rates going on the short end in the next 6 to 9 months, and then it could be likely to get a cut, at the end of 2023. And then I mentioned earlier, so that's up to 5% of where the Fed will bring interest rates. And then on the long end, we think that support on the 10-year yield is around 4.25. We don't think it'll end there. Meaning that's just maybe as high it'll go. Maybe it'll go there through there temporarily, but we think that's more of the resistance, and that the 10-year, I don't know the timing on this, but should settle more down in that 3.25 to 3.5% range once you get through all the hikes and then start cutting. I don't think we'll go back down, to where we were. So recession is still our base case for next year. We think it'll be mild because there's no structural imbalances that anyone in the economics team can see, and because the labor market is so strong. So, every recession looks a little bit different, but our economists think that it'll be a shallow recession in 2023 because of that strength of the labor market. And banks and other companies are pretty well capitalized. Doesn't mean that there's no pain, and spreads are likely to still, go out further from where they are, and as well as equity valuations. Is that equity valuations are probably not troughed either. The compression that we've seen in the equity market so far has been a valuation adjustment. But now we're coming into earnings season. You're probably seeing some of the headlines. Earnings estimates as you go into 2023 likely have to come down. So there could be more pain ahead for the equity market. So that's what we see as far as rates, and as far as recession.
All good news.
And the fact that creds have probably further widening to go.
All right. Should we pop over to OPEB very quickly?
Yes, the OPEB returns are pretty close. I lost for a second. The OPEB return, so I talked about the pension return of in the third quarter or the first quarter of your fiscal year, down 505. The OPEB was down only 503 for the first 3 months. You know, we don't have private, you know, we're just slowly building the private equity, as you heard Matt talk about right now. No really cash flows and different allocations. So the real estate, which is bigger allocation here, you know, 10% allocation within the OPEB plan versus 5 for the pension. That's helped offset some of the weakness in the equity market since we have more public equity exposure here. But yeah, pretty close to all of our targets. So nothing to add on the OPEB plan. Besides the quick update on the performance. You could see the private equity, the private real estate at 11.4%, so slightly above that policy target. But again, that's the denominator effect. All our public asset classes have been falling, and real estate has remained strong so far. I didn't. What's that, Caroline?
I'm just wondering if anyone else has anything they want to contribute, any thoughts or questions? All right, Brian, we're going to keep going here.
Okay.
If that's all right.
Yes.
All right. Yes, yes, I'm very happy for that.
I'm here.
All right, do stay with us though, if you don't mind. All right, guys. So moving on, kind of old business. I'm just wondering if we can get just an update on how the transition's going over to Milliman.
Mm-hmm. We've got a meeting actually going on this Friday. One of our biweekly meetings. I don't have a whole lot more to report. These first probably 3 months are just going to be, figuring out what data they have, what data they don't have, and getting that over there so that they can start working it into their system. So, that process is continuing. We have at this point, we're down to really like very minor tweaks to the pension plan that we've been working on with our attorney, literally like kind of making sure that the names of the unions that are in there are referenced properly, things like that. And then I would say within the next week or two that we would send that around to the unions for everybody to look at and comment on. And then although we haven't started working on it, what we're going to do, because there is no other comprehensive document, is use that document, the town employees plan, as a base for moving on to fire and police, and then just tweak it from there. Because the base should be the same. It's just going to be a matter of changing it for the particulars of each of the unions.
Okay. Terrific. So as we can move on to new business, guys, there's one thing I want to bring up with you, just if we can discuss briefly among us, and Brian Binkley, while you're with us. And that's the next meeting is I'll present to you kind of the calendar for next year that we will vote on. a year ago, at this time, we had the discussion that we would give it, this year, with continuing on with the monthly meetings to see through the transition to Milliman as our actuary and with Vanguard, as our OCIO. I would like to just kind of bring up the idea, gauge your temperature for taking us to fewer meetings per year, so taking it down from a monthly meeting to a quarterly meeting or 5 meetings per year. And for that, Brian Binkley, I just wonder if you could speak for a minute about what your OCIO clients do, firms kind of similar to us, how frequently they meet?
Yes, typically is more of a quarterly cadence. Not much changes from, say, month to month as far as how we go about looking at the asset allocation. So a quarterly cadence is typical with all of the other OCIO clients that I work with. Some are less, but it's not the same type of client as Town of Fairfield. So from a public perspective, I find it very common to be at a quarterly cadence. I, of course, will do what's in the best interest of the committee and meet as frequently as often as we've done the last 2 or 3 years. But from what I work with other clients, a quarterly cadence is typical.
Okay, thanks. I mean, of course, we have to transition to Milliman. We have the need, meetings are happening very frequently between the town and Milliman. We're going to want to have that come back if there's ever a need or anything that.
Yeah, or if there's some, big movement or a big hurdle or something, then, we can always schedule a special meeting to talk about those things. If there's, anything that pops up.
Thoughts?
So you envision potentially maybe a quarterly meeting with Brian, any consideration to doing more of a smaller business meeting, maybe less frequently, so like maybe 4 when we OCIO and maybe 2 business meetings that we can do with, just our stuff as our board, mixed in there, and that's, a much shorter meeting to take care of the business. We're still gonna meet every month, for the retirements, or so you fit the rate.
Yeah, that would be different.
Yeah, that would be different, I mean.
Yeah.
But I think that's what you meant by special meetings, correct?
No, special meetings would be that stuff, like the Milliman stuff, like, or the more business.
So that is, whatever we needed to get together to vote as a board.
Yeah, whether it was Milliman or something else, then,
Yeah, but I mean.
But how would the communication be? I wouldn't want the communication on a more regular basis to kind of slack.
So maybe it's a 6 meetings.
With Brian, Brian only coming to 4.
Right, Brian quarterly, right, and then it's gonna be 2 more that are more business oriented to the balance.
Right.
I mean, I really am curious just to gather everyone's thoughts before we.
4 is, I think, too short.
Yeah.
To interrupt you. Before I've been here 10 years now.
Yeah.
Eric's been here 15. Before that, there was this board met very little, and it was not run very well at all. There was and then there was I think Brian did a great job organizing this and bringing it together, and we had to meet every month, if not more. So I think cutting it down would be good, but I think 4 is
Too few? Okay.
right away, especially in the market. The market conditions kind of crazy. I don't know, that's just.
I think if you did it, bi-monthly and included the quarter months so that you could get a report as to performance, you cut it in half.
Yeah.
Yeah, you cut it in half.
That works for most people who prefer to, spend less time at this, but at the same time cover. And of course, like you say, there's another board for the retirement thing that may have to be still monthly, even if it's for 10 minutes to approve somebody's retirement.
Right, right.
Yeah.
And that, I mean, the officers, we elect officers for each of those 2 separate boards, so that can just come together
Set that
on
up
WebEx.
as a Zoom deal too. So
That's a quick WebEx.
Yeah.
Here's the stuff. You gotta.
No,
So my only concern is, like, I look at it, we're very unique here, where we have 2 separate pension trusts that come together jointly only for investment purposes. Did I lose you? I lost video.
Can hear you, see you.
We're here.
All right, so it's a very unique situation where there's two individual investment trusts that come together for joint purposes. And I look at it as a triad, right? There's the investment leg, there's a liability leg, which there's a huge discussion right now down here about wage inflation and COLAs, which I think that we need to revisit. And then there's the policy leg and the administrative leg. So I just want to make sure that, you know, if we are meeting less as a joint investment committee to look at the asset leg side, that we don't lose the liability and administrative side. Because that's where I think that we're going to, in the next 5 years, is going to be, we're really going to have to focus our time on.
And Eric, maybe it was understood, but for the part I was commenting on was just the investment as a regular cadence. Other town boards still may meet monthly. So I wasn't speaking in general structure, just from the investment perspective. But again, stand by my comment that if you want to meet more regularly, then I'll continue to do that. But just wanted to clarify, if it wasn't understood, that I was only speaking from the investment piece, since you broke those three legs out.
Derek?
If the market is volatile as it is, all of a sudden we go quarterly, and we happen, so it's in Stanford. We had a manager, consultant beat us quarterly, and he came back, said, "Oh, aren't you glad we didn't have that March meeting?" Well, two of the plans said, when it came for RFP, they're no longer there. So, we had that experience where, we know what happened in March in 2020, the market collapsed. We didn't have, we had this quarterly meeting, we had it right before, and then we had a big hole. Market recovered, but, that whole communication piece was a concern. And when you have elected officials on these boards and they're saying, "Oh, what's going on?" And obviously they don't know. And, so that can be a concern for continuing to have regular meetings. It could be shorter,
Right.
if we're not making allocations, but also I think it's important that we consistently have the different fund managers or portfolio managers give us updates, not just the private equity, not just the real estate, but the other portfolio managers, so we have in a sense what's really going on in the fixed income index fund, what's going on, like as I say, normally equities go up, bonds price go opposite, and now we got them both going down, and we know what's going on with equities, but, it's also the education of then looking at other asset classes as they evolve.
I'm just trying to think of the other, from an administration side, we've got the OPEB valuation, pension valuation, those things that we typically review. OPEB's only once every 2 years, pension once a year, but those could be, I think, pretty easily melded into a meeting where we're going over the performance as well. So those things, those things could happen simultaneously. I'm just trying to anticipate and think of other activities that would be going on that we would need, any more than 6 meetings. Obviously there are the retirements that we all have to take care of.
Yeah.
Right.
I think we can kind of set that aside and, those will happen as they happen, but.
Do we have over
You can always call an emergency meeting if need be.
Yeah.
Always call a special meeting. Right.
Like 7 days notice, you have to post it.
5.
5, okay.
5 days notice, but if there's an emergency meeting, we can call a meeting. Right,
Yeah.
there is the out of, if it's a true emergency and we gotta meet, we can do that. Yes.
Yeah.
Right, the real question is how frequently should we get the whole JRIB together? So why don't I, we'll noodle this over and present a couple of options at the next meeting, that we can look at what it would look like and what the what kind of the agenda might look like, what topics we'd cover.
Yeah, I think maybe calendarize it in the sense of saying, every, whatever
Yeah.
April we're looking at the discount rate, or we're looking at whatever, if it kind of calendarize what our plans would be, that would be, and put our
Yeah.
meetings in those.
So why don't we do that,
dates would be
and
interesting.
with kind of an eye toward, can we, what does that, how do we make sure that we have accomplished everything that we want to do, and we're not creating too big a gap?
Would you expect any kind of pushback from Board of Finance or something saying, hey, you guys are,
No, it's up to
they're-
us.
No, I know, but
Yeah.
still,
Optics.
not the, I know it's up to us, but saying, hey, you guys are asleep at the wheel here, what's going
No,
on?
I think we have enough, we've established kind of enough credibility over the years with the Board of Finance, and having both Vanguard as CIO structure, and now Milliman, who works with them as well, we're kind of well flanked.
Okay.
That I think it's up to us. In my mind, I was thinking 5, but I think 6, let's work with the idea of, let's look at what 6 meetings looks like. And I'll present some options. All right? So I'll add that to the agenda for next time, will be the calendar. Okay.
For other new business, the DC plan, like the 401A plans, are we supposed to have oversight at all?
Yeah, we've talked, well, I know you wanted to get them in. And
I'd really like oversight over that, yeah, just to be able to have them in.
Yeah, so let's work that into we can work that into that schedule too.
Okay.
And with that,
Yeah, there was
Is there
an
a committee that-
incredible presentation that. I'm sorry, guys, my video's lagging. I got poor Wi-Fi here. There was an incredible presentation by Aon talking about DC plans, not really meeting the needs of retirees, and how much additional savings an employee would have to make in the personal savings to really accomplish an adequate retirement. It was actually kind of scary, and it was Aon. It was a legit presentation, and it worries me for those town employees that don't have a DB plan anymore, and they're solely have the DC stuff. So yeah, we definitely need to get Mission Square in here and talk about what are they doing, how are people invested, how much are they contributing, are they borrowing against their DC plan, and what's that look like? So
To your question, there's a small committee that meets quarterly, and we meet with Mission Square just to get an update from them.
And then
we actually just had one the other day.
Then reallocations, if there's a change in the menu, I assume that you have many different investment options.
Yeah, there's a whole lot, and they, being what it is and the nature of it, they can't move and make changes as nearly as quickly as Vanguard does in this situation, so. Yeah.
And just
All
for
right,
some
we'll get that on the
transparency, who meets with Mission Square quarterly?
Right now it's me, Caitlin, controller, and Megan Brandt, the benefits manager. And that is by code or charter. When the 401A plan was established, they set that up that way.
Union memberships?
What's that?
No union members?
Not in that committee.
Is everyone coming into the town as a new employee in the 401A plan? There's no more defined benefit for them?
Town employees, right?
Only
Yeah.
town employees?
And DOE
Not
too.
police and fire. Police and fire is still open.
It's still,
Yep,
oh,
yep.
okay. Who oversees all that? You and Caitlin?
The defined contribution plan?
No, the 401A plan. Mission Square.
Mission Square,
Mission
yeah.
Square is a
They administer it,
They
yeah.
set up the plan
Yeah.
and give them a cafeteria, that sort of thing.
Yeah, with,
They're the record keeper.
a a lot of the options that the employees will go for have, you know, it's a fund that has a target retirement date. You know, your date is 2035.
You can choose that, or you can do it yourself.
Yeah, or you have, and there are a lot of options to choose from.
All right, so let's get that, maybe, could we do that in December? Do you think? I don't have a,
What do you mean in December?
We don't have a November one. December 7th is the next
December
meeting.
7th, it's our next meeting, it's our. 'cause we don't
Combines
have a
November and December because of the holidays.
I'll talk to him.
Let me see if we can get them in December,
All right.
and we'll make that our,
Do we clarify, what is our role with, overseeing that in terms of that? What is our responsibility? Just to.
You don't have one.
Okay.
There isn't. No, I think it's just something that,
Didn't Brian at one point want to try and take that under our wing, or no, or what, I forgot, didn't we, an overview of that?
so it was, yes,
Okay.
yes, but it was set up without our involvement,
right,
right?
right.
And so there's always been a discussion of, is there a role for the JRIB acting as an investment board to just have a sense at it, to look at it from a cost standpoint, the menu standpoint, just should this be the second set of eyes?
Gotcha.
But it never was, kind of settled.
Right.
I know
Okay.
Tom Flynn was actually one of the largest kind of champions of the idea of it coming before us at least once a year, just for a review.
Okay.
So I think,
I think
if I
that's
can
bad.
reflect,
I think it's a real bad idea. Why would you wanna have your finger in that and just create liability? We have no say in it.
They have no
You
say.
know, Mission Square, I don't know who they are, but it sounds to me like they're an administrator, broker, and they're just throwing out a cafeteria of funds for people to select for themselves. So could be Merrill Lynch doing it, it could be anybody. And for that matter, Vanguard would do it. They have all kinds of programs for 401A plans, I'm sure. But why would we want to have
To
that?
step in and
Because
have
you have no say in it.
right,
None.
that's true. That's,
Makes no
I
sense.
think the concern was, if I can remember back, at the time, the town's administration was concerned about, there was a series of lawsuits that were filed against municipalities and cities due to misadministration of their 457 or 401A plans due to high costs or lack of employee education. And
Right.
because of that, the town's administration saw the knowledge of the board and said, listen, there's no better place for this oversight to kind of take place than with the JRIB, because we had so many investment professionals on the board that could make sure that A, costs are reduced, B, that there was adequate investor education, and then C, that people were making good quality investments, and not, fully invested in the crypto craziness. Not that it's an option, not that it's an option, but, or again, that they weren't, which you can, borrow against your 401A plan and then, not have an adequate retirement. So those are some of the discussions that took place years ago.
And, those are good points. One of the couple of things that we did talk about were, investor education and, doing some kinds of webinars and things like that. And also, talked about going before the Board of Selectmen as well in January, I believe. Just to, give them an update.
I would hold the people that set it up accountable to do that, because they're the ones that are profiting from it.
That should be part of their service.
Yeah, absolutely.
What's that, to do?
Education.
Oh, yeah, absolutely, yep. And they know that,
Yeah.
and, they're on board. Yep.
If I could speak generically.
yes, Brian.
Oh, I was just going to say, just speaking generically is, for a retirement, like 401A, 401K, you usually have a record keeper that's doing all the reporting, but they also do education to the participants. And then, again, typically there's a consultant that helps a committee select the funds that are offered within the plan. I mean, for instance, like I've worked with 401ks in the past. They don't do it here at Vanguard, but there's usually two different vendors if you think about that way. Someone to record keep the plan, provide education, reporting to the participant, but then working with investment consulting to say, are these funds prudent for our participants to invest in? Is it a mix of active and passive? What active funds? Yeah, do you do something as far out as crypto? I know that's far end of the spectrum, but just wanted to give that perspective if it helps.
Yeah.
And if you ever, I don't think that we are as big in the 401a space, but 401k, there's a wealth of resources that I could probably just share if ever was helpful.
It's a small
Just
number
wanna
of people
mention-
now, is it not? It just started a couple of years ago.
Yep.
Unbelievable.
On
Sorry,
the,
Susan?
Yes, from the employee side, and I think Cheryl could speak to this. I think Mission Square has a lot of, they give you a lot of opportunities to speak to someone. I don't have the 401A, I have the 457, but they always send out stuff to educate the investors. So I think they're doing a lot on their end, and I think I watched a webinar that they had also. But Cheryl sends things out all the time about that. So I don't know if you're worried about individual investors getting educated about the funds. I think there's always someone there that they can speak to.
Yeah, if you guys want to hear from them, they can probably cover that too and say, here, here's what we've done over the past 12 months for education, and maybe lay out a plan or at least some concepts for what they want to do over the next 12 months or so.
Well, I'd like to understand kind of the potential liability side.
Yeah, I think that is,
Well,
let's
right, let's not
jump, let's not get them in here and start talking about what they do
We
for
don't
us.
want to,
No.
whoever in charge,
Yep.
I'm not talking. You need to pay, town has the liability for
Right.
those people. And the program should be set up in such a way is that the cafeteria that they can invest in is so conservative that they maybe they can be sued for being too conservative. So that's the problem.
Right.
And so, I don't know how you really can control that. The borrowing thing he talks about, that can be, you can say, no, there is no borrowing. The town can set those rules. Or you can say you can only borrow 25%, and, obviously you're borrowing from yourself, you pay yourself back, that's how it works.
Right.
But these are issues that people, this, corporations have done away with that liability for a reason. The towns are still assuming it in every way, whether it's a defined benefit plan or a 401k plan. And, let's hope that none of it, I could see 50 years from now, if every town employee is in a 401k plan, you're gonna have some disgruntled, because they thought that they were gonna be more tactical and smarter than the market, and they did well, and they blame the town for letting them do it. Because that's just the way the world is.
Human nature.
And so why would we want to have, we have no oversight, have nothing, have no input into that. You just don't want to do that unless.
I'll second.
Okay, thanks.
I agree with you.
All right, guys, good thought-provoking conversation.
Interesting.
All right,
Don't want to get yourself in trouble.
guys, thank you with that, I think that, unless anyone would like to raise a new topic, I think, we're ready to adjourn. We got a motion to adjourn, Bruce?
Motion adjourned.
All right,
Second.
all right, there we go. Thanks, guys.
Thank you.
Good night, thank you.